the week ahead. Coming into this week, we had a well-defined balance. That balance was also related to a record recovery in the market. With the tariff news on Sunday night, we spiked sharply higher. And as you can see, we've approached the area from which the market broke down in the first time. This sets up an additional risk in the market because it's called trade location. After the close on Friday, one of the rating agencies downgraded U.S. bonds. Now that by itself isn't that significant because all it did was bring the three rating agencies in line. However, since there's so much discussion going on right now in the legislation about bills and more voting on Sunday night, it's going to bring more attention to the potential for the deficit. Also, the 10-year is up near a very difficult area, and it did rally back up towards the 50 level after the close. So what I'm looking at here as we come into next week is that the market is straight on up. We do have a large gap from the weekend. Those are always dangerous in there. The laggards have driven the market for the past couple of days. The question becomes, how do I know it's the laggards? I know it's the laggards from the fact, if you look closely at the daily bars, you will see multiple rallies coming from exacting levels. For example, half back from the prior 30-minute period, from the low, or from very mechanical, easy to spot references. Now, that doesn't mean that they're going to be wrong, but it's important to know that they are weaker hands and they can turn very quickly in the market. Trend is clearly up. I'm not saying the market's going to go down. I'm saying there is substantial risk because of the current trade location and because the most recent advancement has been at the hands of the laggards. Now, add on top of that the downgrade this afternoon, which will bring or possibly bring more attention to yields and to the deficit. And clearly, the bills that are in front of the House right now would increase the deficit even more. Okay, let's take a look at the profiles. When I look at the daily profiles, and I've used the ES profiles here, you see the final profile and how thin it is. When it's thin like that, that is usually an indication that the buying was very emotional. And we know, we've talked about it before, emotional buying has a tendency to be challenged. If the market is to break down, anything serious would find acceptance back below the 58.80 level. That's where the market, if you look at Monday, Tuesday, or early in the week, you see that we have some overlapping, or Tuesday, Wednesday, Thursday, we have some overlapping trade. That overlapping trade gives us some support if the market starts to break down. It's what I call backing and filling. Now, under that 58.80 level, there is no backing and filling. And when there's no backing and filling, that greatly increases the risk that the market can go back down through that level very rapidly. So as we come into the current week, the first thing I will be looking at is to see, do we get any downside follow-through relative to the late break on Friday following the downgrade? If we don't get any follow-through, then the trend still remains sharply to the upside. If we get downside follow-through and get back into the range of Tuesday and Wednesday, then we are looking at the 5880 level. Acceptance back below the 5880 level adds even more risk because there is no backing and filling there. Have a great week, and we'll talk to you next weekend. Bye now.